Good afternoon and welcome to this afternoon's webinar on wills and CAT, or Capital Acquisitions Tax to give it its full title. So just to mention, this is a webinar, so it's not a meeting. So you can see and hear us, but that doesn't work the other way around. Now you can still submit a question via the Q&A functionality within Zoom. And also just to mention that those of you who require CPD, that we will send you out CPD certs after the event. Now, there's just one slide and just a small couple of minutes from myself, okay? And that slide is in the context of what happens to my pension fund on death, okay? So if only the answer was as short as the question, okay? So I'm going to split this up into pre-retirement pension structures and post-retirement pension structures. So pre-retirement pension structures just means that you haven't yet accessed your tax-free lump sum. So firstly, we'll just deal with personal pensions. So just to mention what would happen with a personal pension on death is that the full fund value would be paid out tax-free into your estate. Now, how it comes out of your estate, that would be impacted by your will as to who gets it, and it would be impacted by CAT as to how much the taxman gets out of that, right? Now, for the next one, a PRSA, thankfully is the same answer as the personal pension. The full fund value is paid out tax-free into your estate. Now, as we move on to company pension schemes, the complexity begins, okay? So we're talking about a defined contribution occupational pension scheme. So this differs depending on whether the employee is in service. So that would be like he is an employee of, say, Company A, and he's contributing to Company A's pension scheme. So if he were to die while in service, the limit on the lump sum that's paid out would be 4 times his gross annual salary, plus the value of AVCs, plus the value of any other employer contributions. The remainder would also be paid out, but it will be in a taxable form, be that an annuity or an ARF. Then just to talk about people who would be ex-service, they've left the service, so maybe they left Company A and they joined Company B. So that pension fund accumulated in Company A that they have left, that would be deemed a preserved benefit under the Pensions Act 1990 and would be paid out tax-free into the person's estate. Now, someone who's ex-service might have taken an extra step. They might have moved the pension funds from Company A's scheme out into their own personally owned pension buyout bond. And in this situation, that would also be deemed to be a preserved benefit, and the full fund value would be paid out tax-free into their estate. So then moving on to post-retirement pension structure. So all that means is that looking at the pre-retirement ones that we just spoke about, and after somebody takes their tax-free lump sum, with the balance, they may have purchased an annuity. So if that was a single life annuity, it would die when the person dies. If it was a joint life annuity, it would continue to be paid for as long as the surviving spouse is alive. And then when the surviving spouse dies, that annuity ends. So no capital preservation with an annuity. There is capital preservation with an ARF, and for that reason, they are quite popular. So what would happen there is when the ARF holder dies, the ARF is paid into their estate. So how it comes back out of their estate, again, is impacted by their will. It could be that the spouse now takes over that ARF, so there's a new ARF policy set up in the name of the spouse. And then as the spouse draws down money from that ARF, it is subject to income tax and USC and possibly PRSI, depending on the person's age. If that ARF has been left to children, it depends on the age of the child, right? So plenty of complexity here. If the child is over age 21, it will be subject to income tax at a special rate of 30%. And if that child was under age 21, there would be no income tax, but it would be subject to CAT tax. Also, just to mention the vested PRSA, that's just a PRSA after somebody has taken their tax-free lump sum and left the balance invested in that PRSA, and the rules for the vested PRSA are the exact same as for the ARF. Now, for anyone who's done an ARF with myself, when I send out the ARF policy documents, I always send a letter, and at the end of that letter, I advise that the ARF holder makes an appointment with their solicitor to make sure that this ARF is included in their will. And I also mention that to speak to their solicitor about an enduring power of attorney. Now, luckily here we have a solicitor, our first speaker, so I'd like to introduce Richard Pierse, Managing Partner of Pierse McCarthy Lucy. So Richard, thanks for taking the time to be with us here today, and just over to you, and thank you.
Thank you. Thank you for the introduction, Eoin. I'm here attending to talk to you today about planning for yourself and your loved ones during your lifetime and after your death. Now, the reason I'm here is because Seán Pierse of ABM is aware of the professional knowledge I've accumulated due to family circumstances. I qualified as a solicitor in 1988, and in the 1990s, our grandmother, Mary Pierse, developed Alzheimer's. And I suppose we observed kind of the difficulties that arose from that. And it was a time before EPA Act came in 1996. But next of kin, my father and his siblings, figured out things and assisted my grandmother as best they could. But I got involved in advocating for the elderly and getting resources for them. And also when the Enduring Power of Attorney Act came in 1996, I got involved in promoting the usefulness of people doing that in terms of planning for what might occur to them during their lifetime. And then in 2003, my wife and I were, our fourth child was born, and she's got special needs. She has Down syndrome. And over the past 20 years, we've been involved in a journey with her personally and also professionally. For me, I got very much into the kind of advocating for the new legislation, which was introduced in 2015 regarding capacity, so people have options rather than the simple word of court situation. So with that introduction and background, I'm just going to dive into the generality of the lecture, and you'll see that we'll talk about that lifetime planning initially, about the Assisted Decision-Making Act and the new regime for it and principles that apply to its operation. And then we might discuss how planning after your death by doing a will. But just to say, these issues about capacity will touch on everybody during their lives. It will affect families. Some loved one may be affected, just like it's happened in our family. And in my own situation, you see that I'm related to this. There's 200,000 people reckoned by the Department of Health at any time are affected by cognitive issues. In my situation, certainly it's there in the first one, and in the last item, when my grandmother had it. But we can all suffer from mental health difficulties during our lifetime that can affect our capacity to manage our affairs. And it's good to plan and put some thought into it. Previously, people were made wards of court, and there was no power of their family to deal with matters. It was a black or white thing. One would have to be made a ward of court, the President of the High Court decide matters on behalf, or function in a grey area without legal authority. But thankfully, in 1996, Enduring Powers of Attorney, that law was enacted, and one can, from that time, set out in a document a position about if one became mentally incapable about managing your affairs in the future, a certain designated trusted family member or friend could deal with them for you. There was also, for the nursing home scheme, there was the care representative could be appointed if you didn't have an EPM. Many people didn't. But that's now gone by the wayside because we're into a new area. I've a quote there from Inclusion Ireland about how unsatisfactory the situation was under the old ward of court system, which pertained effectively until last year when the new act commenced. And now we are in a situation where there's a more sophisticated tiered level of support. If one has only minor issues about capacity, just going through some mental health difficulty or being forgetful or whatever, you can have some trusted person assist you in making decisions, collecting information and communicating your decision, but it still remains your decision. But if you're somewhat vulnerable, and lack capacity in a more significant way to protect you, you can have a trusted person be a co-decision maker with you, so that a decision won't be valid unless it's made jointly by you and that trusted person. But that trusted person must defer to your will and preference. And if you are in a situation where you have little or no capacity, then an application can be made to appoint a decision-making representative. The court will appoint one, generally some trusted family member or friend, to make decisions on issues of concern to you, which can be quite broad. It can be your care setting, whether you live at home or need to go into nursing home care, and also your property, financial affairs, managing your incomes, pensions, and such matters. And an option, though, is that you would, while you're still cognitive, and if you think of doing so, doing an enduring power of attorney. And under such document, it's people that you've selected will manage your affairs. I know there are other matters in the Act, but we're not covering those in today's lecture. But an important feature of this new legislation is there is a presumption of capacity, right? So, there's a functional test for capacity, which I've outlined there. It's your ability, in respect of a particular decision, to understand the information, to retain it long enough to make a choice, weigh up the pros and cons, and then communicate your decision. And the whole Act is designed to support you in making a decision under that tiered level in accordance with your will and preferences. And there's a decision support service set up which has brought out codes of practice for all these people that I've outlined here. So people like Eoin and Seán as financial advisors, there's a code of practice for you there, professional financial advisors, in how you, if you become concerned about a person having capacity, how you deal with them, how you assess their capacity, always functioning on the basis of a presumption of capacity. Very useful to read those, particularly the first one there on supporting decision-making and assessing capacity, because you can see situations in those, and they give examples of situations can arise and how you help people make decisions. One functions in accordance with certain guiding principles, which we set out there, including that we can all make unwise decisions. And just because a person makes an unwise decision doesn't mean they lack capacity to make decisions generally. So I've described, yes, there's a process for assessing capacity. If you find yourself presented with a situation, you have to think in terms of that functional test. Act in good faith, and you inform the people about there's a concern about your capacity, and you explain the situation to them, and then you assess their ability to make decisions for themselves, but at all times presuming they have capacity. That all relates to kind of lifetime situation and those structures of supports that are there for you to make decisions, on how to spend your money and looking after yourself. It's very important that you would consider and you would proceed with making a will. Now, a will is a document that only speaks from your death. It will only become effective when you die. And you're still free to deal as you wish with your assets while you're alive. And I give general guidance to people, that once you have looked after your children, seen them educated, perhaps giving them assistance in starting on a house and accommodation, feel free to spend your resources on yourself and enjoy the fruits of your labors through your life. So there might be little estate left when you die, but there might be significant estate left, and in your will, and just in case you die prematurely, you should in your will say who will take charge. Right? Now, this is particularly important for persons with young children, because you should appoint a guardian to look after your children. I think I might have information on that in the next slide. And it could be a couple, perhaps a sibling and his or her spouse, that you might appoint as guardians of your children, and you might do it on a reciprocal basis. The executor will have a job that will last for a year or two in collecting in the assets of the estate and dealing with them in accordance with your wishes. Now, what's very important, and I'm just going to go back here to what is a will. Legal document that you set out your wishes, right? It means you define and specify what becomes of your assets after you die. If you don't make a will, then legal rules will apply depending on your family circumstances, and they may not suit the application of legal rules. And the rules broadly are that if you die with a spouse or civil partner and children, the spouse gets 2/3 and the rest is shared amongst the children. If you die with no spouse, it all gets shared equally amongst the children. But you could have a situation where some of your children are well off and some of them not so fortunate, or maybe involved in a vocation which is not as rewarding, but quite meaningful. And but you could have some children who have a difficulty, perhaps alcohol, drugs, or whatever, and it would not suit that they would get money into their hands. Because it could worsen their situation. You could consider, in such circumstances, or where you have young children, setting up a trust, an arrangement whereby property or cash is set aside in your will for the benefit of a child, not necessarily a child with disability, but certainly you should, if you have a child, or and particularly if the child has become an adult with a disability, to be very important to have a trust in place, setting aside some reasonable resource to be spent in a discretionary manner on behalf of such adult child. The discretionary manner means that there's no definite income in, and it won't be means tested to affect their disability benefit. And as you see there, the legal title of the property passes to trustees, and they manage the income for the benefit of the child. Now, there are discretionary trust level there are discretionary trust levies payable to the revenue of 6% upon of the value of the assets upon creation of trust, and 1% per year. However, such levies do not apply where there are children under the age of 18 in the trust, and there's a certain discretion up to the age of 21. Also, they don't apply where the trust is in favor of an incapacitated person, and this can include an institution caring for your child. And you have there in the slide a definition of what an incapacitated person is, and it extends to people who are improvident, maybe have become homeless, don't have a specific problem, but just can't cope with life. And I've seen situations where revenue will accept such for a trust situation. Now, trustees should not be overly generous with the trust fund at any one time, because it might render the beneficiary liable for tax. Broadly speaking, as I understand it, trustees must though still get out income, because income is taxed at a rate of 20% if it's distributed within 18 months, but thereafter at 40%. It's the trustees are accountable for such taxation and income into the trust, and they have to file tax returns. Also, the beneficiary of the trust may be liable to file tax return, and the tax advice should be got, and those returns filed, and any due taxes paid. So that's the an overview of my contribution, and I look forward to hearing what Brendan Toohey has to say, and we can field questions from you thereafter. Thank you.
Thank you, Richard, for that very informative presentation, which I'm sure the audience found to be insightful. This afternoon's tax consultant with over 30 years of experience is a well-known speaker, author, and contributor to tax journals. Over to you, Brendan Toohey.
Thanks, Sean, and thank you to Richard for that presentation. Very interesting. Now, can you see my slides on your screen? We good?
Yes, yes.
Okay, right. So I have a lot to get through, and I'm going to go fairly quickly. The slides are more detailed than my presentation will be, because I'm conscious of the fact I don't want to go too quickly and miss stuff. So you'll get copies of the slides off Seán and Eoin later on. You can have a look through them yourself. I'm really here to try and sell you on a few key concepts, all right? Which is trying to highlight to you the importance of doing certain things, and the importance of asking the right questions and at the right time. You have to start then, because we work in CAT, all of us here, we're familiar with it. A lot of people mightn't be, so just give a very quick crash course. We say CAT, some people talk about inheritance tax, gift tax, capital acquisition tax. CAT houses three taxes: inheritance tax, gift tax, and discretionary trust tax, which you heard Richard talking about earlier on. There's no real difference between inheritance tax and gift tax. It's more about the timing of it, right? You'll see a lot of language, because people like to do Google these days and do their own research. You're going to see a lot of language which can confuse you when you're trying to research these things. At the end of the day, you've got someone giving something, you've got someone getting something, and you have the method in which you do it. And that's what all the different languages are. If it's a trust, it's a settlor, a trustee, beneficiary. It could be a donor and a donee. It could be executors and beneficiaries and residual beneficiaries, etc., etc. But they're all more or less the person giving, the person getting, and the method of delivery, okay? So by all means, do your own research. There's nothing I like best, and I guarantee you Richard is the exact same. When people come into us and say, look, I've been looking at this, and then we can fill in the blanks. If they have a certain level of knowledge and a few pre-prepared questions, then we're delighted. As long as you tell us that. There's nothing worse than fellas coming and trying to ambush you with some stuff. Aha, but I read this in Google. You're not going away. So the second thing then is, as taxes go, CAT is actually very simple. It's 33% of the taxable benefit, and the complexity tends to go more left. So the available threshold in practice can be difficult to figure out, and the actual value of the benefit at the time, because you've limited interest and life interest and all this kind of stuff, can be difficult to figure out. But once you get those two into the equation, one takes off the other, what's left is at 33%. Couldn't be simpler. It's not like in income tax where you've got USCs and marginal rates and standard rates and all this malarkey. Thresholds, and again, this is a crash course. Thresholds are into three categories. My parents can give me 335,000 over the course of my life. That's important to remember. So if I turn around and hand my young for 335,000 tomorrow, then some stage down the line, he gets something else, he's going to pay tax on it. It's a lifetime threshold. In reality, we ignore everything before 1991. I'm not sure if that's a Premier League football type of thing, or whether it's just the revenue computerized their equipment back then. It's probably the Minister for Finance at the time had gotten a really big benefit in 1990, so he wanted to take him out of the equation. So it suits us fine, because it's a nightmare trying to track back past gifts, and sometimes the executors have to do this, but always tax people have to do this. When you get into your wider family, my aunts, my uncles, my nieces, nephews, vice versa, and all that, then you're into Class B, which is 32,500, which is actually very, very, very small, ridiculously so, I would argue. And then everyone else is 16,250. Now, everyone else is everyone else. So if my neighbour gives me 16 grand tomorrow, I'm delighted. If my neighbour gives me 16 grand in 10 years' time, I have a problem, because I've used up my threshold. And In practice, this is mainly a problem for in-laws, right? Because people, depending whether you like your in-laws or not, you tend to think they're closer than they are. You might be living with your daughter and her husband for the last 40 years and treat him like the son you never had. But from an estate point of view, he's no closer to you than I am, right? So if you want to put me in for 16,000 and leave him out, I have no problem with that. So it's very simple when you look at it from afar. When you get into the nitty-gritty, as I said, things can get complicated. It has got its own regime. It's not linked to the calendar year like our income tax or accounting periods and so forth. The CAT year runs to 31st of October or 31st of August every year, and the deadline for paying and submission is the following October. So you could have anything from 14 months to 2 months, depending on the timing of it. Just to flag a few quick things for you on this. There's 2 dates always. There's a valuation date and there's a date of death. The date of death should be obvious, right? In most cases. The valuation date less so. You can have multiple valuation dates in any estate. As a matter of fact, you usually will have multiple valuation dates in a decent estate. The date of death dictates the rate and the threshold. The valuation, as the name hints, is when you value the benefit, and it dictates which tax year you fall into. So if I get hit by a bus tomorrow and I bequeath everything to Seán, and then in October, they cut the tax rates from 33 down to 5%, Seán, you're stuck with today's rates and today's thresholds, right? But on the plus side, it'll be next year before he actually gets anything, so he'll have until October 26th to deal with everything. But if you just remember that one thing, that's going to be 40 questions I get on a weekly basis, right? So the date of death dictates the CAT rate, the 383 threshold. Any changes in budgets and so forth after that don't matter, no matter how long the estate is. The other thing just to flag to you is that CGT is linked to the date of death. It doesn't change. CAT, as we said, is linked to a valuation date. That's often probate, or at least 6 to 12 months after the date of death. Now, there's all kinds of reasons why you can't have double taxation in life, including case law and actual laws. There are a few exceptions to that. 2 of them arise in this scenario, whereby if I did get hit by a bus tomorrow and I left me rental property to Seán, and by the time he gets it, 12 months has passed, the rent in between here and there can often be taxed twice, income tax and inheritance tax. And if it goes up in value, that will be taxed twice, which is CGT when it's sold and inheritance tax in the meantime. So just be wary of that. I always say to people, if you're dealing with an estate with a property that's going to be sold, put a for sale sign up before you sign off on the probate. Because if you get a valuer out who knows is going to sell it, if he thinks it's worth 100 grand, he'll tell you it's 180. That way, when he says it for 200, you think you're a rock star, right? If he tells you 200 and he says it for 199, you think it's terrible. So when you're selling it, the valuer always goes lower. Well, that's my opinion. I'm sure there's a valuer here, he'll be threatening to sue me, but as I always say to them, for defamation, you'll have to find someone who said you had a good character before he spoke, right? So last but not least, then, I just want to sell a few key concepts to you. And the first thing is to understand where you're coming from. Everyone listening to this, touch wood, is doing something. They're either running their own business or making someone else's business work, or they're investing carefully in all this. And why do we do it? It's to make money. And it's not to make money for us. If it's to make money for us, we don't have to worry about inheritance tax. We'll all die penniless. We'll have a great time. We'll all die quickly, and we'll all die penniless. We don't make money for us. We make money for our families. That's what it's for. So every day you go to work, and when you finish up here and go back to work, whether it's your own business or someone else's, every time you think about investing in this share or that share, you're putting a lot of time, effort, blood, sweat and tears into this, and it's to make money for your family. And I go, are you sure that's what you're doing though? Because what you're really doing is making money for the state stroke German bondholders, right? Because less than a third of all your income stroke salary stroke profits ends up in your family's hands if you're not careful. Now that's your starting point. Once you buy into that, the rest of this is simple. The next thing to remember is there is often competing considerations we take into account. There's estate planning versus succession planning. Estate planning is what making sure you have a very carefully designed will, and that's part of everyone's succession planning, but it is still only concerned with wills and inheritances. And I always say, well, that's plan B. Plan A should always be succession planning, which incorporates that, but also says, what can I do now? Right? Now, what can I do now is not the same as what should I do now. So you'd often have to look at your options. Just because it's more tax efficient to do it now doesn't mean you should do it now if it's not what you want, right? But in very big picture terms, the advantage of acting now is that you've got certainty. I know the rules today, I know the circumstances today, but I also have to deal with a lot more taxes. I've got inheritance tax, stroke gift tax, I've also got stamp duty, and I've got CGT and so forth. Whereas if in the state, I only have to worry about inheritance tax. So the question you'd often have is, am I prepared to pay extra for certainty, right? And sometimes certainty isn't all it's cracked up to be, because while I'm certain of the situation now, right? Like I'm 50 and I have a 20-year-old, so I'm certain what I can do now from a tax point of view. I'm not certain what she's going to be like in 10 years' time, right? So certainty can be overrated. So your first dilemma is now versus later. And that's different to everyone. And it's not always the same answer, even within the estate. It might be given the wealth now and keep the farm, or given the farm now and keep the wealth and so forth. And then you have the me versus my family debate, because at the end of the day, the first thing I say to anyone who comes in to be about succession planning is, are you happy that you're financially secure and financially dependent? And that's different for everyone. My opinion is simple. I don't regard a client as being financially secure if they own their own house, if they have a ready, steady source of income, and if they have rainy day money in case they have to go to Israel for an operation, right? And not be sitting on a trolley for 7 years. So they're my kind of 3 criteria. But not everyone has that. Some people are happy with a life interest, some people are happy with an old age pension and so forth, but that's your starting point. So that's on one side of your funnel. The other side of your funnel then is what you can pass over to your family without the taxman taking a third of it. And what's in between is your funnel. And this can be complicated or simple. If I've a house worth $500,000, I have investments and shares worth $500,000, and I have my old age pension, it's very, and I have 3 kids with full thresholds, sure, happy days. I'm financially secure, and when I die, the whole lot will go in. There's about $1 million in my estate. They can get about $1 million without any tax. Everyone's happy, right? In practice, it's never like that, right? And therefore, you have this debate about when you let it go through the funnel from you to them, with a target of making sure you're financially dependent, but also with a target that when you do get hit by that bus, what's on the left-hand side in terms of your estate and what's on the right-hand side in terms of your family's thresholds match. Otherwise, a third ends up going to the revenue commissioners. This is a third of money you've already paid 50+% on. And of course, if you're of a certain generation, 70, 80, 90% plus on, right? So the other kind of dilemmas that you have, and all I'm saying is, look, lads, if you get more than a third to go from your customers, stroke investments, whatever, to your family, then that's mission accomplished as far as I'm concerned. And everything after that then is about what you should do to get better than that, but always working in the parameters of what you want to do. Now, Richard spoke very early about this in terms of the power of attorneys and all this, making sure that you have a plan B in place, but always you get to retain control while you're able to have control. And that's very important, right? There's not, like, if the world was run according to tax, we'd all still be living in caves eating soya beans, okay? So it's very important that your plan matches what you want and not what's tax efficient. I always say to people, you tell me what you want, I tell you how to do it. That's how it works. I don't tell you what to do because it's tax efficient. It might be more tax efficient to give the pub to the son and the farm to the daughter, but the son might be an alcoholic and the daughter might have serious allergies to sheep or something. So just because it's tax efficient doesn't mean it's the right thing to do. Then you start looking at all the various tools and things, and I don't want to go into all of these, as the slides is quite detailed. I would say, don't remember, there's more than one way to skin a cat, right? And that's a figure of speech, by the way, not an experiment you should be undertaking. And you can transfer the actual asset that's generating the wealth, be it the share portfolio or the business or the rental property or whatever, or you can just redirect the wealth by putting in place family partnerships or future value shares, or using the small gift exemption, using family loans, etc., right? I do want to echo one thing, and I'd be a little bit stronger because I don't have any dog in the race. If you're listening to this and you're over 18 and you don't have a will, then you're an idiot. No other way about it. You go, sure, I don't have anything. Well, you're listening to me on a computer, so you have something, right? The minute you turn 18, you should be made to go in and get a will. And the will shouldn't be complicated. I leave everything to my mammy and daddy, or if I'm married, I leave everything to my wife, and that's it. Now, that's not a good will, but at least it's a will. Now I literally ran a couple out of my place the other day. I literally ran him out, and this is not a lie. I said, look, your solicitor's down. I was down there this morning talking to him. He's in the office. You get into your car, I'm going to ring him, and you're going to know you're signing a will. And the will was everything. If I do everything to her, she does everything to me. If we both do everything to the kids, and that's it. Sign that and come back up, right? And they said, yeah, but like we want to think about what we're going to do with this. Yeah, you can think about it for the next 6 months. You can change your will anytime you want to. But if you delay putting a will in place where you're figuring out what you're going to do, I tell you what's going to happen. You're going to get hit by a bus. You're not going to have a will. It gets complicated very quickly. Even a simple case, even a guy gets hit by a bus and he only has a wife and child behind. As Richard said, it's 2/3, 1/3. You go, so that's grand. I want everything to go to my wife and kids, but it's not going to your wife and kids. It's going to your wife, stop, and kid. So she now is stuck with the ownership of the child. She doesn't have unfettered control about what she wants to do and doesn't want to do. She might be able to take out mortgages and scale up or so forth, right? Now, I'm not saying it's a disaster, but it's not what you want. So I'm going to be a lot stronger than anyone in this. It's not my field, but I know what the carnage can be when people die without a will, right? And you're listening to this thinking, well, we're all thinking, that's grand, I just won't die. Good luck with that. If you can make that work, then that's fine. But just on the off chance, get a will done this week. Get a proper will done at your leisure, but get a will done this week. The last thing to remember then, before we look at just a few kamikaze planning ideas, is the sequence, what happens. Richard made a point that a will only matters when you're dead. It doesn't deal with anything you're doing in your life, and you're free to do what you want to, which is correct. But also remember, your will doesn't even matter when you're dead, right? Your will only matters if there's anything left on the table when you get to that part of your estate. In other words, if you get hit by a bus tomorrow and you owe the revenue 3 million, I don't give a shit what your will says. There's nothing left to carve up, right? So the first thing that happens is you say you die, you have to establish your estate, everyone you owe money to. That includes the revenue, social welfare, and the health board if you've got free legal aid, or not free legal aid, nursing homes and so forth. And of course, your ESB bills, etc. Don't forget that anything you jointly own isn't in your estate. That goes by survivorship. And that's very important, lads. Jointly owned isn't the same as co-owners or tenants in common, for want of a better phrase. If myself and Seán get together tomorrow and throw £1 million into the pot and we go away and buy 2 million worth of shares, then I'm not really making my family richer, I'm making Seán's family richer, because I'm going to die before he is, right? We tried to get him twice already, he's still here. So when I die, everything I have passes to him by survivorship. So be very careful who you get into jointly holding assets with. If it's outside the immediate family, then you need to balk at it. So whatever you get hit by a bus tomorrow, all the jointly held stuff is gone, all the clearances are obtained, and then there's a sequence. There's a specific legacy, and there's whatever's left is in the residue. You know this, you've seen wills. I leave 5 grand to the parish priest, I leave 2 grand to the dog's home, I leave 3 grand to Auntie Mary, and everything else, the rest and residue of my estate to my children, etc. And then you have what we call intestacy rules, which is if you have no will, or there is a will, but people display him out. So it's 1, 2, 3, or sometimes just straight to 3. It's important to understand this, because the one hint I want you to take out of this is we, as a people, we underestimate the importance of specific legacies. All right. And we'll hopefully, there's a few example slides, and hopefully have time to give you 1 or 2 real life examples of that as well. So I'm just trying to sell you a concept here. The concept here is, if you do nothing, if the whole purpose of what you're doing today is to make money for your family, and if all you're doing is ending up at 32% of your family, then you're failing. And I think we can do better. That's concept number 1. Number 2 is there is always dilemmas. That's what makes us adults and have to make decisions. Do I act now and get certainty? Or do I delay? Things might get better, things might get worse, and put a clever will in place. Do I do a hybrid? I don't know. Right? Do I make sure that I have only enough of my estate that my kids pay no inheritance tax, or do I make sure I am happy and secure and retain control for as long as I can? I don't know. These are all the dilemmas that you have to deal with, but you have to deal with them in an informed manner. If you accept that tax planning is simply making sure your family get more than 32%, then you have to do the basics of tax planning, which is avoid the avoidable, avail of the available, to be available, you have to know what they are. Now, if I was to even hint at any of these, it would take more than 20 minutes. So I just listed them all for you. I do want to balk at, I don't want to stop at one of them because it's a hobby horse of mine. We were actually talking about it off camera beforehand. And it's very much the tortoise and the hare of tax planning. I would argue it's the right key of tax planning in that it does the job. It just doesn't get any headlines, right? You ask a lot of Man United fans who's the most important fella this area, can't, and you should stop talking to them, right? So the small gift exemption is huge, and it's a lose it if you don't use it scenario. Now, I'm going to give a very simple example. And these are all real life examples, obviously crude simplifications of them. I have a couple, they're doing well. And I should premise all of these things on the sad news that might have dawned on people. You're going to die. So the assets passing from you to someone else is not a what if, it's a win, right? So I'm sitting with these couple, they're young, they have a 10-year-old, they're obviously young, they're well-to-do, they have a bit of money, and I'm saying, look, you need to do these things. And they say, we've loads of time for this. And he goes, you don't. Because every year that passes without you using the threshold, the small gift exemption, is a waste. So what are you going to do? You're going to wait till your son is 18, then you're going to hand him 50,000 to get a house or to get a college degree or whatever. Then he's going to end up paying 16,000 on that. Not today, but someday. So you're giving him 50, he's ending up with fucking 32. What was the point? What you do is you pick up the phone to Seán or Eoin, you say, right, the two of us can afford to put 500 quid a month into an investment for the next 8 years, and what happens? Right? They don't even notice it. You just go for a Chinese one less time a week. And when the son hits 18, he has 50-odd thousand sitting in his bank account. So instead of getting 32, he gets 54. Like, that's 32 versus 54. You don't need to know anything about anything to know which is better there. So that I'm a huge fan of the small gift exemption, and people don't use it. If you're listening to this and you're well paid and you have kids, do this now, right? And you can do it through banks, you can do it credit unions, but they're more hassle in the work. Pick up the phone to the lads and say, I'm going to put 500 quid a month each for each child. If you commit to a regular payment for a long period of time, it's great. You might not do it for 5 years and roll it over, or for 8 years or whatever, but that's a no-brainer. If you take another case, which is a real case, and a couple I met before didn't do what I told them, they're back in now, and I basically said, look, if you had done this 5 years ago when we sat down, it's just a couple with a child, one child who's married with kids. If you had done this 5 years ago, you would have saved 40,000 by now. Now, if 40,000 isn't a big deal for you, that's great, because I haven't issued my fee yet. But let's assume 40,000 is a big deal. Let's do this. So that's the only one I'm going to pause on, because people overlook it because it's small, it's not sexy. But every year you don't do it, it's lost forever. And once you start doing it, lads, you get it's like Irish dancing, right? Once you start doing it, you can't stop. So if you have a business, you have to look at business link. If you're in your 60s and you have a business, you need to look at this. If you're in your 50s, you can think about it. If you're in your 40s, you don't. If you're in your if you have farmland, in your 60s, you need to look at this. The rest of these things you can look at. Just a flag in Ireland, favourite niece, favourite nephew, accountants and solicitors know about it. We don't tend to spot it in practice. You'd be amazed, like 3 or 4 times a year, I'll see people not having spotted it, could have claimed this relief. The other one, which we never spot, is the foster child. In Ireland, a foster child, in the context of this, it means informally foster child. Those of you separate, a different generation, there's the rural version of this, which is peg seers, which is you get to a certain age, you're pegged off down to the country to work in your uncle's and aunt's farm for the next 10 years. That becomes a child for CAT purposes because they're there for 5 years. If you're from the city, we used to call you the overflow children, where there's 23 of us in one house, and I have an aunt up the road with a spare bedroom, and we were sent up the road to live with her. So a lot of these scenarios that people fail to spot because they just don't know the family history, that there might be a class A as opposed to a class B threshold available there. So just watch out for those. And one very quick one as well, because it's quite niche. Parents can give to their children a class A. Children can give to their parents as class B, all right? If the children dies, it goes to their parents as class A. But what's going to happen is parents are going to turn and give to someone else anyway, and you have a second hit of tax. So if you have anyone that you know, male, female, young or old, who's relatively wealthy and doesn't have their own spouse and kids, number one, I want to know because I have 2 kids I need to marry off, right? And if they have a big enough wealth, I'll divorce, marry them and do it myself. Number two, every 5 years, they should be getting a gift of €6,002 from their parents, so that, God forbid, they get hit by a bus, there's an exemption that goes up to the parents, and then the parents can do what they want with it, right? It's a tiny little mechanism, and hopefully it'll never apply to anyone. But while you're looking at people who are a certain age, a certain level of wealth, might have their own business, might have a few investment properties, whatever the case be, but don't have a spouse and children yet. I could joke that they're related. If I didn't waste my time with my wife and children, I'd have a lot of money. So if they have a lot of money, chances are they don't have spouse and kids. But just all messing aside, it's the difference between 50% and 33% if you do it earlier, right? And I just want to mention as well, tax insurance gets a bad rap. There's 2 types of tax insurance. There's tax insurance on inheritances, the old Section 60s, which are always attractive from paper, but never really attractive from practice because they're overpriced. But then there's the gift tax insurance, right, which is Section 73. And they suffer from the bad press of the life or the inheritance tax ones. I like those because at the end of the day, they're just glorified investments, right? No, I can almost hear Eoin by grinding his teeth and Seán silently judging me. They're not just glorified investments, of course they're not. My point being, in the life insurance one for death, I could pay it for 40 years. It gets too expensive, I stop paying it, and then I get hit by a bus. So what a waste of time and money that was. In the gift one, I can pay it in for 8 years. And if I don't give anyone money in 8 years, I still get a decent return from my investment anyway. The money doesn't disappear, okay? But that's usually oversimplified. But look, if you have money to be investing anyway, and if you have a lot of wealth to be passing on to the next generation, you should be talking to the lads and saying, look, I don't really like the inheritance tax one. Can you explain the gift tax one to me, okay? And you might be surprised. There might be something out there that works very well for you and your circumstances. There's a few examples in your slides. I didn't want to go through them. I just wanted to flag them there for you about how you can just be clever in that. And these are all real cases. I want to split between 3 kids. That's fine if you do it your way. Then you're going to lose 50,000. If you do it my way, there'll be an extra 50,000 end up in your family's hands just by bringing in the in-laws and children and so forth, right? Sometimes that doesn't work because there's often a dilemma between the parents who go, I want to leave everything to the 3 kids and I don't give a shit about the wife and kids. That's their problem. And there's parents who go, I want to give everything to my kids, but I want to recognize my grandchildren separately, and this becomes more complicated. But more complicated is not undoable. It's just more complicated, right? Then we have disclaimers and we have deeds of family arrangements. Again, 20 minutes wouldn't cover any of these alone as part of something, but there are 2 different tools. A disclaimer is a legal thing that we use sometimes for tax purposes. And it's because of disclaimers that we need to appreciate the importance of specified or specific legacies, which you'll see in a second. A deed of family arrangement is where we all get together and decide, look, I know what the dad wanted, but this makes more sense. That's the CGT concept. They can work well together, but they are 2 different concepts, and just be wary of that. And I just want to echo something Richard said earlier. Be very wary of disclaimers and when the operational law determines things rather than your will, because you can be surprised at what happens. I think if I do this, this happens, and it mightn't be. So always get advice before you do anything, okay? Now, trusts, I literally just want to say one thing about trusts, right? There's a concept out there, there's a concept there that a bare trust is good for tax, but bad for everything else. A discretionary trust is good for protection, but bad for tax. And a fixed trust kind of is a good midway point between the 2 of them. No, it is not, right? A fixed trust, it can be, but more often it has all the badness of a discretionary trust and has all the badness of a bare trust, right? It doesn't give you any of the protections. It doesn't often give you the discretions, which are still stuck with discretionary trust tax because of income accumulation. So just be wary of general rules or concepts. And there's more than one way to control ownership. Like, you don't need to put a trust in place if you don't necessarily trust the 18-year-old. You could just put it into joint names of a family partnership and so forth, okay? But I do like discretionary trusts in context of protection. Obviously, There's the medical side of things, which we spoke about earlier, or people with special needs, and or people who are getting to a certain age, or people who have flawed decision making. But there's a very important one in that mix now, which unfortunately has become more and more prominent, which is the improvidence. Now, in the olden days, we're not talking about an actual condition. You're talking about alcoholism, and look, you loved your children equally, but you couldn't trust Seán to look after things because he was fond of drinking. If he gave him £2 million tomorrow, he'd have a hell of a weekend, and that's about it. But that was few and far between, and there was more than one way to skin a cat. What's unfortunately becoming very, very relevant now is drug addictions. And therefore, we're starting to see more and more use of discretionary trusts for people who just can't be trusted to get all of the money at once. Now, improvidence isn't like incapacity in that you don't get all the tax benefits, but you get enough of them to think about the discretionary trust. I'll just put it like that, okay? So look, I put a lot of examples into your slides and notes because I said you can go read them on your own time. They all boil into kind of similar things, which is doing the same things but doing it cleverer. So don't leave the farmhouse and farmland to the son. Leave the farmhouse, 1. Leave the farmland, 2. So if he wants to disclaim the house because his sister's living in it and so forth, they're all in your slides there. I wanted to echo something Eoin said earlier on, but kind of dramatize it a little bit in that now that you can delay crystallizing your pension to your 75, I think pension is going to start having to be really looked at as a way of passing wealth to the next generation, not just as a way of protecting yourself into your retirement. If I have my own business, I could take £1 million out, I could stick it into my pension, I'll give it to Eoin and Seán to manage, so hopefully there'll be £1.5 million there by the time I'll trust you to get to £1.5 million more than I trust me to get 75, I'll put it that way. And then I have to start taking my pension to 75, but I'm not going to eat into it that much, right? And then when I die, I'll make sure my will leaves it to my kids, and as Eoin says, there's a magic 30% rate that it goes to the children if they're over age and so forth, right? Now remember, that's from my company to my kids at 30% tax, 70% in their hands, as opposed to taking it out as a salary, saving it, and dying 32% in their hands, right? So the rest of this then is just, as I said, you can read, I put in the slides and the examples, so you can read them in your own time. So look, what I'm trying to sell here is tax planning matters, otherwise what are you doing what you're doing? There's a succession versus estate planning. Succession planning is always the way to start. It doesn't take estate planning off the table, but it puts other stuff onto the table, right? You can be as creative as you want to be, but don't walk past this silly stuff. Don't only leave it to your son if he's going to share it with his in-law, his daughter, anywhere, his wife anyway. Put her in for 32,000. Don't walk past the 3,000 a year and so forth, right? Be aware that things do change, and you don't always get to control them. You might not always like them. Don't try and impose situations onto your children. As I said, use specific legacies to give them options and so forth. And get a will done today that's bog standard, and then do a proper will at your leisure. But after you've that done, revisit it every 3 to 5 years, because things that made sense today won't make sense then. And most of all of this, right? Do something. Be proactive. Because to leave you on a good note, you will die. Everything you have is going to go to someone else. And if you don't do anything, that someone else is Hans and Gretel over in Berlin Banks. I'd rather it was Tommy and Paddy, right? So if you get nothing else out of this seminar, do something. And if you get it wrong, you don't what's the saying, lads? You don't forget the points that you missed, you forget the points you didn't take, isn't it? So I'll hand you back to the gruesome twosome.
Great. Okay. So we have a couple of questions have come through. So Richard, for you, it's to do with a trust. And the question is, if some or all of the trustees die before the beneficiary, what happens in that situation?
The short answer is the personal representative of one of the deceased trustees could have power to appoint. But I would say broadly that I do advise people to try and pick trustees from the next generation as well as the current generation. If you're an older testator, because it could be that the person who may be one age to you, one of the trustees, may, like you, die or before you or develop issues with their cognitivity. So it's good to have somebody from the next generation to take charge. But I would also say that if issues develop about one of your appointed proposed trustees in your will while you're still alive, do consider making a codicil to adjust who your trustees, and it could be a range of issues, and not only perhaps dementia setting in, but also something might happen about their relationship. They might develop a hostility might develop between them and the proposed beneficiary through life circumstances. Or something might become to light that might make you mistrust those proposed trustees. So, but then go and change things, put in alternative trustees instead.
Most of the time, Richard, I'm assuming anyway, good trustees replace themselves as they go along. It would be rare from the wall to die, wouldn't it?
Yes, and also if there are a couple of trustees functioning and one of them, but if you have two trustees and it's a chore doing a job as a trustee, they might do it for a few years and they might look to retire because they mightn't feel able for it anymore. Then you can go to your solicitor and they can prepare a deed of retirement and appointment of a new trustee. And it's a process that trustees could do every 5 or 10 years as need arise. And you could always have a flow of a new trustees arriving into a situation and other trustees retiring.
Okay.
But it is rare that that's usually what happens. Guys do it for so long and then they already earmark someone else to come in. So it would be unusual for all the trustees.
And there is another option, which is if your estate is quite significant and complex, there would be an option to engage and appoint a professional trustee, and there are good companies out there that do this. They charge, but it can be worth it because they will attend to the complexities in the filing of returns and see that things are done properly and monitor valuation of shares and other tests that are duties on trustees to do and ensure it done properly.
Okay, great. Brendan, for you, there's a question that's come through there on CAT. So on the transfer of the dwelling home, right? So you have the parents die, one of the children, has lived in that house for many years, so they tick all those boxes, right? And that child, I know it's limited, right? But let's assume that they do satisfy the conditions and the child gets that house free of CAT. Can that child also receive 335,000? So, are those things connected or are those things separate?
No, exempt is exempt.
Okay, so the child can get 335K in addition to the dwelling home free of
Exactly.
VAT. Okay, that is possible. Great. Next question is possibly a little input from each of you, right? Like when we talk about CAT, right? I know there's concepts of domicile and residency, and just to give a very simple example, I'll use myself. Born in Cork, right? Never left Cork for too long, right? So I'm Irish domiciled and I'm Irish resident, right? Now, I know once those things change, things can get a bit tricky, right? So the question is from someone who's, let's say, similar to me, but they work, I suppose the difference is their residency could change. They're one of those people who commutes to the UK, they get on a plane on a Monday morning and they come back on a Thursday night. They have some assets in the UK, some, they have a home in each place. Is it possible to talk about if it would be very easy for them to alter their residency to the UK?
I'll go first. You don't want your residency. It is what it is because it's from a different view. It's maths based on your days. The English have the similar, but you also have vague concepts like habitual visits and so forth. But if you want a big picture, there's three things. There's the person giving it, the person receiving it, and the item itself. And my rule is simple. If any one of those three is Irish, you're going to have to deal with Irish, right? If they're English, and I say English for the UK, right? If they're English, then you may also have to deal with the UK. You're lucky. Now, we only have 2 treaties. We have double tax treaties with loads of places when it comes to corporation tax and income tax. We've only got 2 when it comes to CAT. That's the US and the UK. So you won't pay a tax on both. You'll get some kind of credit for one against the other. But your assumption will be if any one of the 3 of them is here, residency-wise or citrus-wise, you're going to have to deal with Irish CAT. Now, This would normally be a problem because you can only be resident, you can be resident in two places, you can only be domiciled in one place. As you may know, the Brexiteers have changed the concept of domicile, that if you're living in England for 18 or 20 years or something, you become domiciled there. So Bob Geldof is now famously domiciled in both Ireland and in the UK, even though you can only be domiciled in one place. So if this was to continue for another 15 to 20 years, he's going to have a very interesting case, but that won't be my problem. You anything to add to that, Richard?
Yeah, I just make a supplemental observation that where the property being inherited is here in Ireland, there will be tax anyway, irrespective of where the person is resident or domiciled. For example, where the testator is US and beneficiaries are US too, they would pay tax, and the person making the will in the US has said all my assets to the siblings or whoever family in the US. In that situation, and there happens to be, say, a house in Ireland, that house going to be sold in due course of the estate. Inheritance tax will be payable by the US beneficiaries having regard to the value of the Irish property only. There is no reckoning of the fact that they're also getting US assets, because the parties are resident domiciled abroad, so assets outside, or otherwise Irish law would take into account the generality of the assets being inherited if there was residence and domicile, so or some one or other were resident here, but because it's abroad, then it's only the Irish assets get taxed.
There are some other questions, but maybe I'll just pick one and we'll finish on that because we've just got a minute over time. Probably for you, Brendan, how do revenue value growth shares issued to children?
That's a good question. I can answer that very simply. Whatever you've done is wrong. Right? And bear in mind, I speak for a firm, and you know, the office next to me here does work for revenue, right? He does valuation work for revenue customers. There's no right answer. How does any value shares? It's based on a combination of EBITDA, capital value, and future expectation, profits, and so forth, right? But if I put three valuers in a room, I'll get four answers. That's the reality of it. So there's no, the fact that they're growth shares doesn't change the dilemma you have. How do you value things? It's based on opinion. Now, what you'd often do in a scenario like that is, if I believe ABM Limited is worth £1 million today, and I want to give the future value to Eoin Jr., my future value shares, I'll put a buffer in place. I'll say the first £1.5 million stays with these shares and the future value goes to them. I will put that buffer in place in anticipation that down the line, the revenue will have no problem getting someone to say our valuation was wrong. Because they don't say our valuation is wrong today, by the way. They say the valuation is wrong in 10 years' time when you sell ABM for 20 million, right? And you only got 1.5, and they say, oh, well, the valuation was wrong. So I'll always put a buffer in place in anticipation of the revenue reevaluating afterwards, which only ever happens if the success of the business. So you don't care.
Sure, I have you. No, great. Look, we're just a small few minutes over time, so we leave it there. And just thanks very much to Richard. Thanks very much to Brendan. We really value your time, and thanks for the knowledge you shared with us today. So that's it, everybody. Thank you.
Thank you.
Bye bye.